Well, good morning, Bob.
Good morning, Bill.
We're sort of on a bright and cheery morning, but it feels like winter is just around the corner and it seems sort of dreary. It's raining across a lot of the country and the temperatures are entering the chill phase, sort of like the mortgage market.
Yeah. Good tie-in there.
Well, I mean, let's talk. We've had the chill phase or I guess maybe it was the heated up, the foreclosure market, and it's sort of entered the chill phase. We're going to be talking about that. So today's discussion is around the market, foreclosures, and just the general mood in politics after the election. It's amazing. Very few people actually got out and voted.
Now voted. Well, you know, this is the 6th year of Obama's term, and virtually every two-term president in the 6th year, things go sort of south for the party that has the presidency.
It seems as though that about every 2 years, it appears like the Congress is changing.
It's been Republican now for a while, and now the Senate is Republican.
But I mean, it wasn't that long ago that both houses were Democrat.
That's correct.
And then it wasn't that long before that they were both Republican.
Well, maybe the voting populace is just very fickle.
Maybe they're just fed up. They might be just fed up.
Well, it's hard to know. It's certainly the case that the turnout was very, very low, and that always favors Republicans.
Well, so there are two schools of thought on why we got the results that we did. Actually, maybe more than that, but one school of thought is that people were just fed up with the incumbents. There were more Democrats than Republicans running, and so we just said goodbye to the incumbents.
Well, that would be true if the House had changed.
But it didn't. It actually increased seats.
Right.
So that theory, you dismiss that theory. Right. The second approach is not that many people voted, and so the ones that did were they had a lot of fervor and they had a lot of passion, and they went and voted for their candidate. And so I heard a great line the other day about someone was talking about where we're going to legalize marijuana in all the 50 states, and a political strategist said it will be a while. It will happen, but it will be a while, and the reason is young people are in favor of marijuana but don't vote, and old people are opposed and do vote.
Right.
Did you vote?
I did.
You did. Okay. It's okay, Bob. It's okay.
Right.
All right. So we're going to talk about the mortgage market, and we're going to talk about what's going on in foreclosures, that sort of thing. See, it just feels like the foreclosure market is back.
It is, and
for our listeners, the foreclosure market we talk about typically short sales and REO. Right?
The MBA third quarter delinquency survey just came out, and
so I'm late, but I haven't gone through foreclosure yet. I'm just late. I'm delinquent.
Well, they talk about foreclosures and delinquencies in there, and they provide some numbers, and it's really interesting the difference between the judicial states and the non-judicial states.
So for our listeners, a judicial state is one in the Mississippi East that has to have a court proceeding for foreclosure to occur.
Right.
So it tends to take longer.
A lot longer, and it builds up a large number in the system. Right now, the average across all judicial states is that about 4.1% of the loans are in foreclosure.
4.1%.
4.1%.
That's a lot, but was way
But
down.
in the non-judicial states, it's 1.27%, which is back to normal.
That's about back to normal.
Right. So that's gone real well, and I think you can also see it when you look at the peaks of where we were in terms of total foreclosures across the country. In judicial states, we peaked at 8%. Is that right? Yeah. No, I'm misstating it. 7% in the second quarter of 2012.
It was 7 or 8. It's still a big number.
No, it's a big number. And but in the non-judicial states, we peaked 3 years earlier, in 2009. And that was only at about 3.8%.
So they got all their dirty work done quickly.
They just moved it through the system quickly.
However, most of the big states with foreclosure activity, tend to be judicial states.
Right.
Florida, for example, is notorious for taking a long time to effectuate foreclosure.
Right. Although Florida has been really improving, they are no longer in they used to be the #1 in terms of how many they had in foreclosure. They're now #2.
Who's number one?
New Jersey.
New Jersey.
And so New Jersey has taken their while. They're at 8% right now.
Wow.
Florida is at 6%.
So it's still bad.
Right. Now you can compare that to the 2 worst states that are non-judicial. And the worst is Nevada at 3.2%.
And that's way down. That's coming way down.
Right. And D.C., which was way up, but they changed their law to make them more non-judicial, and they're at 3%.
All right.
So it's those are way down, and they're approaching that steady state.
I'm surprised D.C. has any foreclosures. I thought the politicians all took care of each other and had jobs, and I guess they just don't pay their bills.
Well, I think you may be true, but that's only part of D.C.
Well, so let's talk about, you've got some other statistics on foreclosure. Let's talk about some other things, and then we'll sort of segue into the market and where we are.
Well, it's real interesting, Guy. If you were to look, if you just lined them up, all the states, and ordered them by the percent in foreclosure, it's really interesting because it's just real clear that the judicial ones have all the high numbers, and the non-judicial. So if you put a line at, say, 2%, virtually all the non-judicial states are less than 2%, and virtually all the judicial states are more than 2%.
So how long to work off this overhang in the judicial states? Because it appears that we've about got it worked off in the non-judicial states.
That's correct.
And so the question is, how long to work off the overhang in the judicial states?
It's going to be two to 3 more years at the current rate.
So we ask at FNC, when we sit around doing strategic planning, because we manage the valuations of a lot of these defaulted properties, these defaulted loans for clients, we ask, how long will this market have this big overhang? And so you think 2 to 3 more years.
For the half that's there. Now, of course, every year it gets less.
Sure.
Right? And so, there's the volume keeps going down, but until to get it all the way through the python, you're probably talking 2 to 3 more years.
We saw our servicers solve about 25% of their problems last year.
Yeah.
And part of that are the servicing transfers. Many of the lenders are transferring servicing to non-bank servicers.
Right.
And so the question is that going to go away? I mean, we've seen the Benjamin Lofsky, who's the New York Department of Financial Institution regulator. Is that going to go away?
Well, there are 2 thoughts.
Because they canceled the Aqua and Wells canceled the deal.
And you can think about it in terms of a institutional thing where, doing those transfers, they've got legal issues and that sort of thing. And then you can think about it going away because there's just nothing left to do.
Well, that's true.
Okay, and that's going away gradually. I was just looking at short sales are down across the country about 50%.
Well, the demand for reperforming loans in the secondary market, and I'm not sure what a reperforming loan is. Some people have a definition, hey, at least 6 months.
Uh-huh.
But many of the players in the secondary market want to see 24 months of reperformance. So someone has gone bad, and now they've agreed to some new terms and conditions, and they're paying as agreed. How long before they're truly reperforming? The secondary market loves those loans because they've been able to buy them at a big discount. Now they've got them cured, so to speak, and so they're back to almost face value.
And they're going into that. For a while there, we had a massive amount of investors just buying up properties.
Right.
And they were mostly all cash deals. And those all cash deals compared to last year at this time are down about 20%.
Right.
So they keep going down every year.
So the 20 to 25% in terms of a size of a market decline, we've seen that with at least 2 or 3 data points.
Right, exactly.
And so what do you think is going to decline in 15? Another 20, 25%?
On the all cash deals, yeah, I would think so. But
Will the judicial states get it down that far?
they've been dropping at a fairly consistent rate, but it's not fast. It's
So you think it's a lump, maybe 15% this next year?
Yeah,
in
yeah.
terms
I
of
think so,
servicing?
yeah, probably.
And so that means that we're going to see markets beginning to, if they have a preponderance of distressed sales in those markets, they're going to begin to heal.
Right. And so, you know, a lot of times it's kind of interesting the way the markets work on the pricing. If there are a lot of distressed properties in a neighborhood or an area, really there is no non-distressed market. It all becomes at the distressed pricing.
It converges to the distressed levels.
But then when you only have a few distressed properties, they just have a significant discount, and the arm's length transactions are really dominating the market. And then there'll be a significant discount for those distressed properties.
And so what are we starting to see? We're starting to see the markets converge.
You know, one of the things that we do for some of our clients is that we give them an estimate of the pressed value for that property.
The distressed value and the arm's length value.
Right.
And so we have people that buy distressed deals, and they want to know what it's going to take, what kind of uptick they get if they cure that problem.
Right.
And then we have others that buy performing deals, and they want to know if it goes distressed, how much of a haircut they're going to take.
Exactly. And so we've always been estimating that, and the way we estimate that is that we look at the ratio of the distressed properties to an equivalent property that's non-distressed. And in some of those markets, they're virtually the same price where there are a lot of distressed properties, but as they are fewer and fewer distressed, that difference keeps getting larger and larger, and we're seeing more and more cases where that difference is fairly significant.
Well, speaking of difference being significant, we're out of time. So this is FNC's Morning View. I'm Bill Rayburn with Bob Dorsey. We hope you all have a warm week, and we'll see you same place, same time next week. Goodbye, Bob.
Goodbye, Bill.